Our next guest says stimulus is the only thing propping up the markets right now. And believe it or not, it's time to get the heck out. Joining us now, Keith Springer, president of Springer Financial Advisors. You know, you're saying that stimulus is basically just driving this market, but that means we need more stimulus then, because we're almost done with what we got.
That's pretty much, you hit it right on the button, Tracy. It's stimulus, it's driven, it's addicted to stimulus. That's what this market is all about. It's kind of like a bat out of hell. You hit it right on the button again. This market is just looking for more stimulus, and it's being driven. The correlation between the stock market and more free money printing, it really is incredible. As you can see, every time we have it, stimulus takes 6 to 9 months to feel in the economy. It takes 6 to 9 months to last in the economy. So we're pretty much running out. We're most likely going to get something, at least some form of a twist, some liquidity if something happens in Greece. But this market's addicted to it. And investors obviously can't sit in cash. They just need to be careful. Look for dividends, you know, invest for need, not for greed, more to speak.
Because you're saying if we don't get more stimulus, the market has essentially peaked. You know, it's up about 80% since the March 2009 lows. So if we don't get stimulus, market's peaked. You're saying it's time to get out of Dodge.
Yeah, pretty much, Tracy. We will get it, but the idea is the bull market is getting a little old. We're in about the 42nd month of this bull market. Bull markets average 39 months. We're in the 4th year of a presidential cycle. It's typically the peak. Market typically goes down in the first year and bottoms in October of the second year. Normally a correction or a bear market. You know, but on the other side there's a lot of liquidity. It could prop it up for a little longer. I'm looking for the market to rally back towards the election. But investors, again, need to be a little bit more careful. It's not so much getting in and getting out, taking a whole lot of risk. It's, you know, invest for what you need to get. If your portfolio doesn't need all the risk, don't take it. You know, pick up dividends, pick up income from corporate bonds, preferred stocks, MLPs, things like that. You can still find, you know, for our clients, we're still finding 6, 7, 8% yields.
Right.
You just don't need all the, you know, all the risk of the market.
Are you're a gold guy too, huh? You know, gold was at $1,900 an ounce at one point. Are the fundamentals still there to push it back up?
The only reason you buy gold here, Tracy, is because gold is the third currency. If we get stimulus, gold will go back up. Gold is acting as basically a counter to the debasing of the dollar and the euro. Every time they print money, gold is stacked simply as another currency, and that's what it is. And you know, the ECB came in yesterday with more money. We saw Bank of Japan talk about it. We saw the Bank of England talk about it, and we're going to see the Fed talk about it. This is probably a good time to buy gold for that reason.
So are you buying gold, though, or are you buying the miner stocks?
You know, I don't buy the miners. The miners have had a big disconnect over the last few years. You just haven't seen the correlation, so you got to go with what works. I've been buying GLD. I buy GLD because you want the ETF, the GLD ETF, because unless you're going to buy a lot of it and you want to store it and you buy the actual gold itself, the miners just haven't participated. So, you know, you can't fight the trend. Now, if they're not going to work, go somewhere else. What's
really interesting, though, is gold is a play on inflation, and yet we're seeing consumer price index. We saw yesterday prices coming down.
We are actually in a deflationary environment. That's a great point. We're in a deflationary environment, but typically you see gold go down, but gold is acting as a third currency.
Right.
So there's a disconnect between inflation and deflation. It's really just all the printing of the dollars and the euro that's pushing gold up, and that's the reason. If you took away the stimulus, that's why you saw gold fall from 19 to 1,500, because people didn't feel like there was any reason to buy it, and there's certainly no inflation.
Yeah, and I just think we go back to the bat out of hell analogy and pull up the Meatloaf song. Keith Springer, thank you so much.
Great song. Thank you, Trace. Glad to be here.
Have a great weekend.
Loved it.
All right.